Hello everyone. So in this session we will be seeing an example for admission of a partner and using memorandum revaluation account. Memorandum revaluation account is revaluation account prepared outside the books of accounts. Now let us just see the example first. X and Y are partners in the firm. Their profit sharing ratio is 3:2. Z is admitted as a partner in the firm on 31st December 2020. New profit sharing ratio of X, Y and Z is 1:1:1. Now, following is the balance sheet as on 31st December 2020. Now, this balance sheet is before admission of Z. Liabilities amount, assets amount. On liability side, we have capital X, Y, 2,50,000, 1,50,000, total capital is 4 lakh, reserves 1,20,000, term loan 2,50,000, creditors 1,65,000. Then asset side we have plant and machinery 2,20,000, furniture 55,000, stock 1,32,000, debtors 1,25,000, cash 53,000, bank 3,50,000 and total of asset side is 9,35,000. Then following adjustments are required to be done before admitting Z as a partner. First, revalued amount of assets and liabilities. We have plant and machinery 2,50,000, furniture 50,000, stock 1,30,000, creditor 1,50,000. Second, there is a bad debts of 5,000 which is required to be recognized in the books. Third, term loan installment of 5,000 is paid through bank. Entry for the same is not passed in the books of accounts. Fourth, goodwill of the firm is valued at 45,000. Fifth, Z has invested rupees 1 lakh in capital account through bank. Z has also made payment of his share of goodwill in cash. Prepare memorandum revaluation account, partners capital account and balance sheet after admission as on 31st December 2020. So we are required to prepare a revaluation account, partners capital account and balance sheet. Now, let us just revise what are the steps when we are admitting a new partner in the partnership firm. What are the steps? First step is revalue all assets, liabilities. Then once we revalue the assets and liabilities, then we have to pass some pending entries if any. Now this revalue all assets and liabilities. Now in this method what we are doing is we are preparing a memorandum revaluation account. Now memorandum means account is prepared outside the books. Now when we prepare a revaluation account, normal revaluation account or profit and loss adjustment account in the books, all the assets and liabilities that are revalued, all the amount of assets and liabilities is changed to the revalued amount. But when we are preparing a memorandum revaluation account, this memorandum revaluation account is prepared outside the books of accounts. So here all the values of assets and liabilities in books will not be revalued. They will remain the same. Only revaluation profit or loss needs to be transferred to the capital account of partners. So what we will do in this case? Now, the impact of increase and decrease in the asset in memorandum revaluation account will be same. If there is an increase in the asset and decrease in the liability, then credit memorandum revaluation account. If there is a decrease in the asset or increase in the liability, then debit memorandum revaluation account. Now, normally when there was a proper revaluation or profit and loss adjustment account, what we did was we debited or credited that revaluation account and the second effect of that entry was given to your asset or liability account. Now in this case we won't be giving any effect to asset and liability account. All the assets and the liabilities will be at the same value. They won't be at a revalued value. So now what we do is, once we find out the profit or loss on revaluation, now this profit and loss is distributed among old partners in old PSR, that is old profit sharing ratio. Now, since the second effect of this entry is not given and this memorandum revaluation account is prepared outside the books of account to find out revaluation profit and loss, what we do is we reverse all these entries whatever are passed in the memorandum revaluation account. Now, if we reverse all the entries, what will happen is, whatever, if there was a profit earlier, now we will get a loss. If there was a loss earlier, we will get a profit. Now this needs to be distributed within all partners in new PSR. So this is how we prepare a memorandum revaluation account. Second step is reserves. Now this reserves needs to be distributed among old partners in old profit sharing ratio. Then third is goodwill. Now new partner will bring in his share of the goodwill, and share of the goodwill which is brought in by new partner, that is Z, needs to be shared by X and Y in their sacrifice ratio. Now these are the steps. Now what we will do is, first we will go through all the adjustments and prepare a memorandum revaluation account. First adjustments, revalued amount of assets and liabilities. Plant and machinery 2,50,000. Now plant and machinery was 2,20,000. Now plant and machinery has become 2,50,000. So there is an increase in the value of the asset. So what would have been a normal entry? It would have been asset account debit to revaluation account. But in this case, we are preparing a memorandum revaluation account. So we won't be affecting the asset account. So on the credit side of memorandum revaluation account, we need to pass this entry for 30,000. So this is a memorandum revaluation account, and we have debit side, credit side, particulars, amount, particulars, amount. Now this plant and machinery, there is an increase in the value of the plant and machinery. So what we are doing is, on the credit side of revaluation account, we are passing this entry by plant and machinery account 30,000. Now memorandum revaluation account, we are preparing it in the two parts. Since we need to reverse all these entries later, we are preparing a memorandum revaluation account in two parts. Now what we can do is, we can simultaneously leave some space for first part, and then we can reverse this entry in the second part. So now here we have recorded this by plant and machinery on the credit side of the revaluation account. Now here we will reverse this entry to plant and machinery 30,000. Next, furniture 50,000. Now furniture was 55,000. There is a reduction in the value of the asset. So normal entry would have been your revaluation account debit to furniture account. So in the memorandum revaluation account, on the debit side, we have to record this 5,000. So memorandum revaluation account debit side to furniture account 5,000. Now let us reverse this entry simultaneously. So now in the second part, by furniture account 5,000. Next, stock 1,30,000. Now the value of the stock was 1,32,000 in the balance sheet. There is a reduction in the stock. So the natural entry would have been your revaluation account debit to stock account. So in the memorandum revaluation account, on the debit side 2,000. Memorandum revaluation account on the debit side to stock account 2,000, by stock account 2,000. Next, creditors 1,50,000. Now creditors in the balance sheet is 1,65,000. There is a reduction in the liability. So the entry would have been your creditors account debit to revaluation account. Now in the memorandum revaluation account, on the credit side, we will write this by creditors 15,000. Memorandum revaluation account, credit side, buy creditors account 15,000. So let's reverse this entry immediately. In the second part, to creditors account 15,000. Next, there is a bad debts of 5,000 which is required to be recognized in the books. Now 5,000 is the bad debt. So entry for the bad debts will be bad debts account debit to debtors account, right? And this bad debts would have been written off in the revaluation account. Now what we will do is, instead of writing it off in the revaluation account, we will just write it in the memorandum revaluation account. Now this entry for the bad debt, that is bad debts to debtors, this entry we will not pass it. Now what we will do is, for this bad debts, we will just record this bad debts in the memorandum revaluation account and then reverse it. And once the partner is admitted, we will record this bad debts in the books of accounts. So in memorandum revaluation account, to bad debts 5,000, and I am immediately reversing it. By bad debts account 5,000. Instead of bad debts, we can also write to debtors account 5,000 and by debtors account 5,000. Now since we have recorded this in memorandum revaluation account, it will not affect the debtors account. So what we will do is, once the partner is admitted, we will record this actual bad debts in our proper books of accounts, and then at the end of the year, this bad debts will be transferred to profit and loss account. Next, term loan installment of 50,000 is paid through bank. Entry for the same is not passed in the books. Now, term loan installment is paid through the bank. So what will happen? What will be the entry for the term loan? There is a reduction in the liability. So the entry will be term loan account debit 50,000 to bank account 50,000. So now here, in term loan, there will be reduction in the amount of term loan. The balance was 2,50,000. Now 50,000 is paid. So balance will become 2 lakhs. In bank account also, the balance was 3,50,000. Now we have paid a term loan of 50,000. So now the balance will be 3 lakhs. Now here I'll just write down the adjustment number which needs to be adjusted in the term loan account and bank account. So this will be helpful for us when we are preparing a balance sheet. Next, fourth is goodwill of the firm is valued at 45,000. Now this goodwill, we need to prepare a working note for the goodwill, and we need to find out what is the Z's share of the goodwill, and this needs to be distributed to the other partners, that is X and Y, in their sacrifice ratio. So now let us prepare a working note for a goodwill. 45,000 is the amount of the goodwill. The old profit sharing ratio is 3:2. The new profit sharing ratio is 1:1:1. So now working notes. 1. Calculation of the sacrifice ratio. So we have partners X, Y and Z. Then old ratio and new ratio and the difference. Now difference is new ratio minus old ratio. If new ratio minus old ratio is negative, then it is sacrifice. And if new ratio minus old ratio is positive, then it is a gain. Now alternatively, your sacrifice ratio could also be calculated as old ratio minus new ratio. When old ratio is greater than the new ratio, then it is a sacrifice. But just to have a consistency in calculating the ratio, what we do is we are calculating new ratio minus old ratio. So if we get it negative, then it's a sacrifice. If it is a positive, then it is a gain. It is easy to understand and remember. Now old ratio of the partners, X was 3/5, Y was 2/5 and Z is a new partner, so old ratio is 0. New ratio is 1/3 for all the partners. Now difference 1/3 minus 3/5 is minus 4/15. 1/3 minus 2/5 is minus 1/15. 1/3 minus 0 is 1/3. So that is, we can say 5/50. Now We will ignore the denominators here, and sacrifice ratio of X and Y is 4:1. Now, second working note is calculating share of goodwill of Z. So goodwill of the firm is 45,000. Then Z share of goodwill is 45,000 into 1 by 3. So that is 15,000. Then this will be shared between X and Y in the ratio of 4:1. So this 15,000 will be shared in their sacrifice ratio. So X share will be 4 by 5 into 15,000. So that is 12,000. Y share will be 1 by 5 into 15,000. That comes to 3,000. Or there is one more method in calculating what will be X share and Y share. Now this here we have got negative 4 by 15 and minus 1 by 15. Now what we can do is we can take the entire goodwill of the firm into 4 by 15 for X. So we will get 12,000, or entire goodwill of the firm into 1 by 15 for Y, we will get 3,000. Now this is an alternative method. So now remember this, if we are using Z share, then the ratio that we take is 4:1. That is their sacrifice ratio that we have calculated. If we are considering the goodwill of firm, then we will consider this ratio, that is 4 by 15 and 1 by 15, which is calculated here including the denominator, because here we are considering goodwill of the firm. So we can follow either of the method, we will get the same result, that is X share of the goodwill is 12,000 and Y share is 3,000. Now who is the partner that is gaining? Z is gaining. So the entry for this will be Z's capital account debit 15,000 to, what is the next one? To X capital account 12,000 to Y's capital account 3,000. This will be the entry. Now we will be preparing a partner's capital account, and then we will post this entry in the partner's capital account. Now this is a partner's capital account, combined partner's capital account for X, Y and Z. So on debit side we have date, particulars, X, Y, Z. On the credit side, date, particulars, X, Y, Z. Now on 31st December 2020, buy balance carried down 2,50,000, 1,50,000. This we have taken it from the balance sheet. Now let us pass this entry for the goodwill. What is the entry for the goodwill? Entry for the goodwill is your Z's capital account debit to X capital account to Y capital account. So on the debit side of Z's capital account on 31st December 2020 to X capital account 12,000, 31st December 2020 to Y's capital account 3,000. Now we also need to give the effect of this entry to X capital account and Y capital account. So on the credit side of X capital account and Y capital account, 31st December 2020, buy Z's capital account 12,000 for X and 3,000 for Y. We have to be very careful in posting this ledger entries wherein there is transfer of something from one partner's capital account to others. We need to post the entries in the correct column of the partners. Now the next one. Now this fourth adjustment we have already done. Goodwill of the firm is valued at 45,000. We have found out what is the share of Z and it is distributed between X and Y. Next, Z has invested rupees 1 lakh in the capital account through bank. Now here Z has invested 1 lakh in capital account through bank. That is, there is a investment through the bank account. So he has invested money in the bank. So the entry will be bank account debit to Z's capital account. Now in balance sheet bank account, I'll just mark this as 5 since there will be a change in the bank balance. And in the partner's capital account on the credit side, I'll post this 1 lakh. So now in the partner's capital account, 31st December 2020 by bank account 1 lakh on the Z's column. Next, Z has also made payment of his share of goodwill in cash. Now, Z has made a payment of his share of goodwill in cash. So, Z has brought in his share of goodwill in cash. What is the share of goodwill of Z? 45,000 was the total goodwill of the firm. Share of Z was 1/3 of 45,000, that is 15,000. Now, this 15,000 is brought in cash by Z. So, the entry for this will be your cash account debit to Z's capital account. Since we have not raised the goodwill in the books, we have adjusted it through the partner's capital account. We will be crediting the Z's capital account for bringing in the cash for goodwill. So now in cash, I will just mark it as 5 because there is a change in the balance of the cash, and for preparing a new balance sheet, I need to make some adjustment here. So now the second effect will go to the partner's capital account, that is Z's capital account on the credit side. So Z's capital account on the credit side, 31st December 2020 by cash account 15,000. Next, now we have finished all the adjustments. Now let us go to the steps. Now first, revalue of all the assets and liabilities. Now this is done. Then past pending entries. Now this is also done. Now memorandum revaluation account we have prepared. Now let us find out profit and loss from the revaluation. But let us first see if all other steps are completed before finding the profit and loss. Second step, reserves, old partners in PSR. Now reserves, if we go to the balance sheet, we can see there is a reserves of 1,20,000 here. Now this reserve need to be distributed between the old partners. Who are the old partners? X and Y in the ratio of 3:2. So 1,20,000 needs to be distributed between X and Y in the ratio of 3:2. Now reserves is having a credit balance. Now we are distributing it to the partner's capital account. Now this is reserves is a past profit. So now the entry will be reserves account debit 1,20,000 to X capital account, that will be 3/5 of 1,20,000, and to Y's capital account, that will be 2/5 of 1,20,000. So on the credit side of partner's capital account, we will have this entry posted. So now partner's capital account credit side, 31st December 2020 by reserves account 72,000 and 48,000. The 72,000 is 3/5 of 1,20,000 and 48,000 is 2/5 of 1,20,000. Now the second effect of this will be we have to reduce it from reserves account while preparing our balance sheet. So reserve will be 0 in the new balance sheet. Now step 3 is goodwill. Now we have already calculated what was the goodwill share of Z, and it is already distributed in for X and Y in the sacrifice ratio. Now we have completed all the steps except for transferring of profit and loss of revaluation of the asset to old partners and then reversing the same entry, and that will be distributed to all partners in new profit sharing ratio. Now let us go to the memorandum revaluation account. Now, this is a memorandum revaluation account. Let us first see the first part. Now, this is the first part. Now, if we see the credit total is greater than the debit total, so credit total is 45,000, debit total is minus the debit total, we get 33,000. Now, this 33,000 is profit on revaluation. So to profit on revaluation, transfer to partner's capital account X and Y. This 33,000 is distributed to X and Y in the ratio of 3:2. That is 3/5 of 33,000, that is 19,800 will go to X, and 2/5 of 33,000, that is 13,200 will go to Y. So on the partner's capital account on the credit side, partner's capital account on the credit side, 31st/12/2020 by revaluation account, we have 19,800 and 13,200. Now, if we see, we have prepared a memorandum revaluation accounts. Now, in memorandum revaluation account, we have not affected any value of asset and liabilities because of revaluation. But since we need to find out the profit and distribute it to the partners in their profit sharing ratio, we have passed this entry of the revaluation account in the partner's capital account. Now, only one effect of this is given, right, in partner's capital account, because memorandum revaluation account is outside the books. It is not in the main books of account. Now what we will do is we will reverse this entry. Now reversing of this entry is in part 2. Now this is a part 2 of our memorandum revaluation account. What we have done is we have already reversed all the entries whatever were passed in the first part of memorandum revaluation account. So now let us see here. What is the debit side total? Here is greater than the credit side. So now 45,000 minus credit side total, we get 33,000. Now same amount we get, whatever profit on revaluation that we got in the first part, same amount we will get on the credit side, that is on the opposite side in the second part. So this is like a reversal or profit, or this is a loss. Now this reversal of profit should be transferred to partner's capital account in their new profit sharing ratio. That is, this 33,000 will be shared by X, Y and Z in their new profit sharing ratio. So now the entry for this will be your partner's capital account debit to revaluation account. So on the debit side of partner's capital account, let's post this. So on the debit side, 31st December 2022, reversal of revaluation profit 11,000, 11,000 and 11,000. That comes to 33,000. Now, what has happened because of this entries? Now, if we see individually X, Y and Z. Now, X capital account was credited by 19,800. Y's capital account was credited by 13,200 and Z's capital account was credited by 0 amount in this entry. Now, once we had reversed this revaluation profit, we have reversed it in new profit sharing ratios. So, now this X capital account was debited by 11,000, Y's capital account was debited by 11,000 and Z's capital account was debited by 11,000. Now, if we see the net difference, what has happened here is, if we see the X capital account, it was credited by net 8,800. Y's capital account, that is 13,200 minus 11,000. So that comes to 2,200. It was credited by 2,200 and 11,000. Z's capital account was debited by 11,000. Now if we see 8,800 plus 2,200 is 11,000. Now if we see this 8,800, we calculate the ratio for this. 8,800 is to 2,200. So that is 8 is to 2. Then what we get is 8 is to 2, so that comes to 4 is to 1. Now if we see this 4 is to 1 is a sacrifice ratio of X and Y. We have already calculated 4 is to 1 as sacrifice ratio of X and Y. So now because of this memorandum revaluation account, what has happened is, now X and Y have shared some proportion of the profit of Z in their sacrifice ratio and Z has borne the loss of that net value. Okay, instead of sharing a total profit of 19,800 and 13,200. They have only shared 8,800, 2,200, and the Z has taken that 8,800 and 2,200 is borne by Z. That is, it is similar to your adjustment of goodwill, wherein Z has contributed to them the profit in their sacrifice ratio because he is admitted to the new firm and he has gained because of this. So this is similar to the goodwill adjustment which has happened. Okay, so this is the impact, overall impact of this memorandum revaluation account. Now we will close this partners capital account. Now partners capital account, total of all three partners on credit side is greater. So X is 3,53,800, 3,53,800 minus debit side total. So 31st December 2022 balance carried down 3,42,800. Y 2,14,200, 2,14,200, 2,03,200. Balance. Then Z 1,15,000, 1,15,000 minus debit side. So we get 89,000. Balance. Now this balance will go to the balance sheet. Now what we will do is we will prepare a balance sheet. Now for preparing a balance sheet, what we will do, we have already got one balance sheet before the admission of the partner. Let's go through that balance sheet, and from that balance sheet we will take the value of all the assets and liabilities, and we have already marked some assets and liabilities which has the adjustments. So let us adjust that amount in the new balance sheet in the internal column. And for partners capital account, we have already prepared this partners capital account. So whatever final balance we got it here, that we will take to the balance sheet. Now let us go to the balance sheet first. Now this is a balance sheet. Now for balance sheet, we have capital account. So capital account will take it from partner. Then there are some adjustment for reserve, term loan, creditor, then cash and bank. So those adjustments we will do, and all other amounts we will take it as it is. And for these adjustments, we will put the amount in the internal column and then we will adjust it in the balance sheet itself. So now this is a balance sheet as on 31st December 2020 after the admission of the partner. Now if we see liability side, capital account, the capital account X, Y and Z, 3,42,800, 2,03,200, 89,000. This we have taken it directly from the partner's capital account. For the other assets, what we have done, for the asset that has adjustment, we have taken those amount in the inner column, and for other assets, we have directly written in the outer column. So plant and machinery, 2,20,000 from the balance sheet, furniture, 55,000 from the balance sheet, stock, 1,32,000, debtors 1,25,000 from the balance sheet. Then now cash we have taken 53,000, we have taken it in the inner column. Now there was an adjustment in the cash wherein 15,000 was brought in by Z, so we will add that, add cash brought in by Z, 15,000. So now the cash balance is 68,000. Then bank, 3,50,000. Now in bank we had some adjustment. There was a term loan that was paid. So less term loan paid, 50,000, and add capital by Z, 1 lakh. So now the balance in the cash is 4 lakh. Balance in the bank account is 4 lakhs. Then reserves, 1,20,000. So we have distributed this reserves to partners capital account. So less distributed, 1,20,000. So nil. Term loan is 2,50,000. Again for term loan we had an adjustment. So less installment paid, 50,000. So now here it is 2 lakhs. Creditors, there was no adjustment. So 1,65,000 on the outer column. Now total of capital is 6,35,000. Now if we take the total of balance sheet, that is assets and liability, it comes to 10 lakh. So this is how we prepared a balance sheet. So this is how we prepared a balance sheet in case of admission of the partner. Now whenever memorandum revaluation account is prepared, what we need to do is, We need not pass any entries for revaluation of assets and liabilities in the books of accounts, but the revaluation profit or loss needs to be distributed to the partners, that is old partners, in their old profit sharing ratio, and then the same entry is required to be reversed, and while reversing, what we do is we will distribute it in the new profit sharing ratio including the new partner. Now because of that, what has happened is there is a net impact in the capital account of the partners in their sacrifice ratio. So the treatment is similar to the goodwill, that is whatever is the profit share of Z that is distributed to X and Y in their sacrifice ratio, because Z is gaining and X and Y are sacrificing their share. So this was about your admission of the partner, accounting treatment of the admission of the partner by preparing a memorandum revaluation